Good morning and welcome for joining us. This is the first part of our three-part series, Passport to Passives. And over the next couple of weeks, we'll have an in-depth look at the pros and cons of passive investing, the myths around passives, and also how to use passives. So if you haven't yet registered for the upcoming seminars or webinars, please do so today. So I'm Gerbrandt. I'm an associate portfolio manager at Morningstar Investment Management, and I'm your guest host for today. So before we quick kick off, I just want to get some few housekeeping out of the way before the real fun starts. So Chris, as you met, will be presenting on what passive investing is and why so many people are currently converting towards it. This should take around 30 minutes, and then we'll open the floor to Q&A. So please use that Q&A function in the chat. As the questions come up to mind, please fill it in. There should be plenty of time afterwards for Q&A and discussions. And then also lastly, please stay online until the end. There's a questionnaire that's going to pop up. Please complete it. And if you want those elusive CPD points, you will need to fill in your ID number. So at Morningstar, we take a holistic view when we're constructing our portfolios. We believe there's a place for passive and active fund and portfolios. And why we are liking passive funds is there's a diversification benefit that you get by using them. You get predictability of returns, and the best of all, at a very low cost for investors. So Morningstar is one of the biggest supporters of a CoreShares S&P SA Top 50 fund. And we like that fund especially is because they invest in the top 50, not just the top 40 of stocks. And also that they cap the exposure to the larger companies, giving us the diversification and broad market exposure. And all of that at a low cost for our investors. It has been really great since we started investing, seeing how that fund has grown and seeing how our peers, our advisors, and our investors are adopting the strategy and coming to realize the benefits of using passives in their products and solutions. So before I give you over to Chris, I just want to give a quick background on him for those who don't know him yet. Chris has over 9 years of financial service experience across investment management, investment banking. And prior to joining CoreShares, Chris was at Grindrod Bank, where he was instrumental in developing the growth of the Grindrod Bank's ETF business, and that later became CoreShares. And he's currently responsible for the product development, research, and all the capital market activities. So before I hand you over to Chris, how are things on your side of the world? I hope you guys were super busy during this lockdown period, and you had a lot of client requests from your side.
Yeah, I mean, we've had, Gerbrandt, we've had lots of requests. I must say lockdown has taught us how to engage on Zoom, and I promise for everyone, we did actually trial this before. We joined an hour before and all the IT glitches come through. But I've really enjoyed the last few days or so. We've actually been engaging with clients in person, and all the benefits of Zoom and the IT benefits of working from home and so forth. They can't replace that personal, engagement that we've experienced over the last few days. So that's been great. And hopefully things remain open and, we don't see a third wave coming on anytime, soon, so that we can continue to engage with clients and build up relationships. And I must say at Morningstar, we've met with in person already as things opened up. And, we certainly used all of the technology available, when communicating with them and catching up with them. So, it's a new world, but there's still some old world ideas that exist. And I look forward to engaging with all of you guys in person more going forward. I must say, I do look forward to that.
Great. So I'm having you, Chris. I'll see you a bit later with the Q&A section.
Thanks. And welcome everyone. And as Gerbrandt mentioned, please ask as many questions as you like. I can't actually see the questions in the Q&A panel while I'm sharing my screen. So, I will take all of any questions sort of after the presentation. Today, the intention of this webinar is not to be hugely technical, but it's kind of, we're looking at addressing a number of things. We're looking at addressing, the kind of the simple, what is passive, and why is passive growing so much? And then obviously there's a whole lot of South Africanisms that relate to the passive growth, and we're going to dive into that. So once again, thank you for joining. My name's Chris. If I've engaged with you previously, it's nice to catch up again. But if not, please reach out to us. And a big thanks to Morningstar for extending this to their client base, who are big supporters of our top 50 fund. We've gathered close on 3 billion rand in assets now in that strategy. So it certainly is one that's resonating with investors, and hopefully we can demonstrate why the kind of growth of that fund has its place. So first of all, we're having a look at active and passive, and as I mentioned, this is like the idea of this was passive passport. It was to start from the base, from the foundation level up, and then move forward. 6 odd years ago when we started CoreShares, we were way beyond the active versus passive argument. Gerbrandt touched on the fact that they utilize both. In fact, our name CoreShares even stems from this, progression beyond active or passive, and rather speaks about a core satellite approach, which looks at how you actually blend active and passive in a solution, and how you can complement those different strategies by using the right kind of active managers alongside passive, and equally the right kind of passive building blocks alongside some of your active managers. So at a very high level, passive really seeks out market returns. And that's rather challenging because there are a lot of different benchmarks out there. There's the top 40, everyone's familiar with the all share. Now there are all the capped variations that have come, the all share capped and so forth. Then we've got this kind of strange SWIX methodology that exists in South Africa, shareholder weighted indices. So there's a lot of different market returns, but essentially what passive does is seek out a market return. It's typically low cost and efficient, low levels of turnover. To give you an idea, the average sort of beta, the average market cap weighted passive investment will only turn over around 10%, relative to active, which can be anywhere from 50 to 200% turnover in a year. So, low turnover. And then, of course, you're seeking out market returns. So no tracking error. There's no deviation from that return with the exception of costs. Active, on the other hand, seeks to outperform. They do this through stock selection, or they have an outcomes-oriented base. And in their stock selection process, they may incorporate a number of different elements, but we won't get into that. They tend to have higher fund turnover. They tend to have higher costs, and they have higher tracking error. Now, what tracking error means is a deviation from the market return. So a high tracking error means you should, as an investor, expect to deviate from market returns over periods of time. That's the risk you're taking on for the potential of outperformance. And really the way we see core satellite and active and passive working together is on this kind of scaling approach. You cost control, you're moving more towards passive, so you want lower costs in your solution. You're moving towards passive. You want a lower manager risk, so not picking the worst manager in class or even someone below in the last quartile. Then you're moving towards passive. If you're comfortable with manager risk, you can move towards active, if you've really done your work. And then this idea of tracking error, now it's an interesting one. We've got a lot of advisors on this call. Tracking error is very, kind of an institutional mindset, but really what tracking error means for advisors and clients is expectations management. So, when the all share did 20% and your fund did 5%, clients are unhappy. They feel aggrieved. Why did the market do 20%, but I only did 5%? I mean, often you'll get the questions on the downside and not on the upside, but tracking error does bring in a lot of behavioral biases, a lot of behavioral elements, and advisors more and more are understanding, almost as what Gerbrandt said, is the predictability or the consistency of the outcomes of just the market, of passive. So as I say, we're not a, sell all your active portfolios and buy passive kind of manager. We talk about embracing both passive and active, combining them in a solution to achieve the best possible outcome. So really high level stuff. Now, I'm going to go into what is an index and maybe a little bit of history about index, because index funds have exploded globally in the last 20 years, but they do have quite a long history, and it's quite an interesting history. One of the first indices, and certainly the first indice that gained sort of popular recognition was the Dow Jones Industrial Average. Now, Dow Jones is also an interesting kind of concept. Charles Dow, who's the Dow of Dow Jones, he was the co-founder of the Wall Street Journal. So he was a journalist. he was looking at a way that that he could measure market returns, a barometer, if you could call it that, of the economy. And naturally, as someone publishing information about markets and so forth, the idea of having a way to measure market returns became very popular. Interesting to note that Dow was a kind of a journalist and Jones was actually a statistician. So there's this kind of meeting of the two worlds, the stats, numbers guys, and then the guys who actually want to talk about market returns and a barometer of what's happening in the economy. Sort of 30, 40 years down the track, Financial Times, we now know FTSE, which is the precursor, the Financial Times 30 index is the precursor to the FTSE 100, UK-based index. This was the first cap-weighted index that gained popular kind of recognition, and that was in the 30s. And things happened quite slowly thereafter. S&P Dow Jones, again, Standard and Poor's, another combination literally of a statistician, a hard numbers man, and someone in the publishing media put together what's known as the S&P 500 index, and probably the most recognizable and most well-known index. Now, between 1957 and 1976, when Vanguard launched the first, publicly available index fund, the Vanguard 500, which tracked the S&P 500, there was starting to be a number of grumblings in the academic world, in the research world, which were making their way and bubbling their way into Wall Street. Now, what was interesting was that the academics started noticing that these barometers, these like the S&P 500, for example, the FTSE 30, they were actually quite good investments. They tended to be very difficult to outperform. And a whole lot of economic theory came out of this, efficient market hypothesis. There's a whole lot of kind of economic background that I won't go into. But what they noted was that, these barometers, these ways to measure money managers and investment managers were actually quite difficult to outperform. And so in 1976, very famously, John Bogle launched the first index fund that was publicly available, the Vanguard 500. And it was a complete flop. Wall Street said it was un-American. They said, what's going to happen to all those analysts and stockbrokers and fund managers? And, surely the American dream is this idea of not just being average, because, the idea was that the index is just the average. So, it was considered un-American, and it was known as Bogle's folly. So it was known as basically John Bogle, who was this well-known investment guru on the markets, his kind of big mistake. Fast forward, 20 years, and Vanguard's assets suddenly start approaching 100 billion, under management, and suddenly this idea of index investing starts to take shape. Post that, what do we see? We see a global financial crisis. We see massive disconnect and trust in the financial services industry. And actually what people now want, post GFC and all the mortgage-backed security fallouts and so forth, was transparency. They actually wanted to know what they're investing in. They wanted to be fully replicated. So you're actually owning the shares, no derivative overlays and so forth. And there was this huge boom into passive. And Vanguard, I've just used as an example, but they're kind of the poster child for passive management globally, now sits with in excess of $6 trillion under management. It's a mind-boggling number, and if you look at that growth, it really is mind-boggling. So that kind of gives you an idea of where index investing came from. It actually came from quite a good place, and it took a long time to establish. I mean, it took 120 years from the first index to actually establishing kind of main market acceptance. But what is an index? When I'm talking about an index, I'm talking in this context about market cap weighted indices. And this is a really simple, really quite silly example, but it shows the idea of how an index works. Really what a market cap weighted index, which is what the FTSE 100 is, it's what the S&P 500 is, it's what the top 50 is, or the top 40. These are all market cap weighted indexes. It actually holds a share in exact proportion to its size. So it's very simple. The larger the share, the larger the weight that share has in the index. So this is an example of company size and then how that translates into index weight. So very simple concept, but it naturally has become more complex. We're sticking today to the idea of just cap-weighted index. So this is a hypothetical top 2 index. That's kind of what it would look like. This is a real index. This is the S&P SA 50 index, which is the 50 largest shares proportionately weighted by their size. So the largest share gets the largest weight. But as I say, times have progressed. This actual index has a 10% cap per share. So, risk management overlays and so forth, they're coming more and more into indices. So, an index, the idea of an index is that it's a diversified basket of shares which represents the economy. And fast forward, the idea of an index fund is that you can own that capital market or what represents the fund. So the example of the CoreShares S&P SA 50 index tracking fund, the job of that is actually just to buy that index in the identical weights that they exist in the S&P index that they provide to us. So CoreShares contracts with S&P. We buy the intellectual property for the index. They send us daily holdings and corporate actions and so forth, and we wrap that in a collective investment schemes fund. It's a unit trust like everyone's familiar with. The only difference is the mandate is actually just to track that index, to hold those shares in exact proportion with the index. FSCA regulated, and it's managed by CoreShares Asset Management, an asset manager that looks identical, for example, to another active manager that you'll all be familiar with, the big houses. So we literally have portfolio managers and a portfolio management team who sit, and their job is to implement this index on a daily basis and ensure that it's as efficient and as close to the index weighting as is possible. So that kind of gives you a very high level, nice overview of index investing. So why do this? Why just blindly go and buy the largest companies, on the market? Why would that be a good investment proposition? There are a number of reasons that underpin it. Diversification is one, costs are another, but we want to sort of look at it from an interesting perspective. And I touched on it briefly. I touched on, talking about, when these indices were first introduced as market barometers, that people started to realize that actually they were relatively difficult to outperform. And this is a trend that hasn't really changed through time. This is a snapshot of the end of last year. And essentially, what we see is that, compared to our top 50 index, as an example, 95% of active funds have actually underperformed this index over a 5-year period. Now, you may say, this is very specific to the period and so forth. But what's interesting and why passive is gathering more and more traction is because the consistency of the story, the live story, if you will. So not looking at historic information, looking at the live environment. This story is starting to become repeated more and more consistently through time. So Gerbrandt touched on, they like passive because of the experience, the consistency of the experience. This is a one-off period in time. If I have a look at the same research, which looks back 5 years and rolls forward over every 6-month period, what you can see is this trend of consistently the vast majority, north of 75% of managers, active managers who are trying to outperform this index, actually underperform the index. So, one of the reasons why we're seeing, for example, our top 50 fund gather traction in the last 2-3 years is when we were telling the story in 2015 and 2014, the market was saying, yeah, guys, but live money and we want to see live track record and so forth. Well, now fast forward to June 2020 and to 2021, and we're starting to show that this is not just a theoretical exercise. In reality, this is actually an extremely difficult benchmark to outperform, and even more difficult to outperform it on a consistent basis. So where people are interested in performance, the idea that you pay up, you're willing to part with 2% fees, let's say for an active mandate because they've got the skill to outperform, the reality is the probability of that manager outperforming is very low. And the probability of them doing so on a consistent basis is also very low. Why is this? So a big driver, and really not to be underestimated, is the importance of costs. And cost stems below just management fee. It moves into the efficiency, the trading efficiency. I spoke about turnover earlier, but costs is as Morningstar puts it, and this is the research side of the business, the single largest determinant of a fund's future success. So in other words, this is actually not a passive versus active debate. It's just saying if you've got two funds, let's say they're two active funds, the probability is that the fund with the lowest cost will outperform the fund with the highest cost. Now, that is very simple. The reality is that the ongoing friction of the costs, that relentless, removal of management fee on a daily basis from the fund, erodes a large proportion of the active management benefit. And if you're overcharging, well, then you're eroding a larger percentage of your value proposition. So the value proposition of passive is to say, hang on, before and after costs, what can we give you? So here's your returns before costs. Let's say the average actively managed rand and the average passively managed rand is identical. Let's assume that if passive funds owned exactly half the market, well, then active funds would have to own exactly the other half of the market. But if the average cost of the active manager was at 1.5%, their average return after costs would be significantly lower than the average passive experience. So it's very interesting because the idea, and we're going to touch on it now, of the index being average is actually not true. The index is actually consistently above average. And it's above average because of what William Sharpe called the arithmetic of active management. It's the zero-sum game of taking costs out of a fund, the zero-sum game of this erosionary effect of costs in the system. As Morningstar put it, costs being the largest determinant of a fund's future success. And as I say, that's not even an active versus passive debate. That's just a fund debate. And it often falls on deaf ears as an active versus passive debate. But I love the research because it's actually just saying, guys, you know what? It doesn't matter how you manage your money. If you've got a lot of costs, it's going to cost your investors. And kind of touching on what I was talking to is looking at the average experience. So looking at the ASISA General Equity Peer Group, and if we look at that over extended periods of time, we can see that on average the peer group significantly underperforms the top 50. In our instance, that's our index of choice, our benchmark of choice, and obviously more well-known, the top 40. And that stems, and that a lot of that comes from this idea that the average active manager is simply charging far too much. So when you aggregate their returns, they're stripping far too much returns out of the client experience, and you get these massive underperformances relative to index on average. So the message that I want to leave with you, and I'm sure, when you've spoken to Gerbrandt, I'm sure that they've said, guys, index is not average. But I want to leave that idea with you because actually we see over here, index is on average in the top quartile. Index in the last, say, 10 years has been top decile. So when you're buying an index fund, you're not copping out. You're actually making a very explicit decision. You're going to buy and hold this investment. It's market neutral, and we've got a very high probability of beating the average active manager. And that's a massive change in mindset. That whole idea of Bogle's folly and buying the S&P 500 being un-American because, why should you settle for the average? Well, all of that needs to be debunked. The index is not average. The index is above average, and it's far above average on average. So why passive? Why is it boomed like this? I mean, all of these these stats numbers, as I mentioned, they've been around for a long time. But, there was a little bit of a kind of a light bulb moment with a lot of investors, and Warren Buffett, probably the world's most famous active manager, came out and said, essentially, that his advice to his trustee would simply be buy a low-cost index fund. And really that kind of sparked this shift into passive management globally that really has been a tidal wave of assets moving out of active and into passive. And that's been, was a massive catalyst for globally why passive has gathered so much traction at a kind of more of a psychological level than it was a stats level, because those numbers have existed for decades, as I mentioned earlier. Another thing happened, he obviously made that famous bet with a hedge fund manager, he said over a 10-year period, you can pick any hedge funds, you can pick the smartest managers on Wall Street. I'm picking the S&P 500, and I bet you $1 million that you won't outperform it. And over that 5-year period, or over that 10-year period at least, he significantly outperformed this active manager who was kind of a Wall Street guru. He actually challenged Wall Street, and this guy came forward to him. So the question is, yeah, that's great in South Africa, but is our market different? Because that's the kind of the rhetoric, or one of these myths that we want to deal with. How different is the South African market? It's a smaller market, it's more concentrated. What is the experience? Well, why in a small market, should we buy passive? Because surely the active managers can actually select the stocks that they think are good, and kind of ignore or exclude the stocks that are not good, and outperform the index. So what I've done here is I've just pulled the same stats, and those same stats from developed markets and emerging markets, and then having a look at the South African numbers. So this global boon into passive in the developed markets has actually been with passive having, or at least active, having a higher probability of outperforming the index than has been the average in South Africa over the last 10 years or so. So it's interesting that this, the South African market's so much different because it's small and concentrated, and active guys have the edge. In reality, their numbers are actually showing worse off. In the cold light of day, South African active managers are worse in their own market than when referencing developed market active managers and emerging market active managers. It's not to say that there aren't active managers that will outperform, but it is to say that when we look at the numbers, our market is not different. In fact, it is different. It's harder to beat our index. Now, we'll touch with kind of some other things. The reality is that it's fair to say, and I'm scrolling back a bit here, that through all this period, we've seen like global bull markets, we've seen equity markets run risk on and so forth, less so in South Africa. And so an argument that's been put to us is that, I'm hanging on to my active manager because they're going to protect me in a crash. And when we look at the numbers again, global financial crisis, 61% of active managers underperformed during the crash. Now that seems like a better number than 83. So yes, maybe there's an argument, and maybe active managers are improving their risk management techniques. Let's look at the COVID crisis, and 69% underperform the benchmark. And one thing that's really interesting about this is when we started talking about this last year, we started seeing people sort of move money in the direction of passive mandates, not just ours, some of our competitors, because they started saying, well, I've hung on to this active manager who significantly outperformed the benchmark for 5-10 years. And then the crash comes when all the value should be unlocked, and I get this huge alpha event. And the reality is that it didn't happen. And it didn't happen for a large percentage of active managers. Only 31% of active managers outperformed the top 50. Now, the top 50 is interesting because I'm sure you're all sitting there and thinking, well, the index holds 25% of Naspers, and Naspers held up the market, and so on and so forth. But the top 50, unfortunately for that argument, is a capped exposure. So Naspers doesn't exceed 10% in that particular fund. So, the myths, we really need to investigate them because there's a lot of rhetoric that exists. And it kind of, to close off, and it brings me to my next point, and it's a point of diversification, is looking at this idea of diversification, because more and more we hear that you can over diversify and you can erode returns, you can dilute returns. And I mean, at CoreShares, we've got an evidence-based investing philosophy. That means that we look at hard evidence. We look at independent evidence. It should be academically sound. It should be statistically significant. It should exist in our market and global markets and so on and so forth. So, we like looking at what's out there beyond our echo chamber inside our asset management business. And these are famous quotes, but I think often underestimated and misunderstood. Harry Markowitz said diversification is the only free lunch. That's really well known. But I like the way that Charles Ellis, who's very well known in the global investment world, he was the chairman of the Yale Investment Committee, director of Vanguard, founder of Greenwich Associates. So this guy, He's a giant in the investment world. He says that diversification simply says, I don't know everything. So I can't really make extremely smart decisions on very specific pieces of information. And he goes on to say, and this is paraphrasing because it's from a video interview, it protects you from these unique, dreadful events that you thought, wow, how could this ever happen to such a nice person like me? And it costs, what he says is it costs nothing to have it. So this free lunch concept comes through, and it's enormously valuable. So again, I'm going to reference our local market because a lot of people will think, well, our indexes, the top 40, the Aussie, are not well diversified. We've got Naspers up at 25, 30%. So what I've shown you here is that when we look at a fund like the top 40, which has no risk management, has no single stock caps, we look at the performance. And then we look at something like the S&P SA 50, which is the fund that Morningstar is talking about. It's got a 10% cap. So far more diversified. When we are holding only a 10% weight in Naspers, the top 40 could hold a quarter of its exposure in Naspers. It means that the effective exposure of shares, so when we look at what drives performance, is almost double, almost 25 shares in the top 50 and about 10 to 12 shares, that drive performance in the top 40 because they're just so big. And what's really interesting, and this is the free lunch concept, we diversify the top 50, we cap it at 10%, but we don't give up on the upside. The free lunch concept that Harry Markowitz is talking about, he's saying for the same level of expected return, we can achieve it at a lower level of risk by diversifying. So it is not a return sacrifice. It is simply a reduction in risk. And that's exactly what Charles Ellis said. He said that it costs nothing, but it's extremely valuable. And so diversification is often something that's misunderstood in our market, in the index world, because the conception is that, or the misconception is that only top 40 funds exist. There aren't actually well-diversified index funds, and we would kind of challenge that in terms of looking at other exposures like the S&P 50. Charles Ellis said we don't know everything, and I just wanted to end on this. Importance of diversification. Now this is zooming out of, we've been talking about like equity indices to asset class indices. This is a graph I love showing because it's like this, looks like a periodic table, scientific chart of elements, but really what it shows is how hard it is to predict which asset classes will perform best, in which conditions, and how these asset classes move from top performing to bottom performing. Property is a perfect example. One of the top performing asset classes in the world is a property. Last 3 years, one of the worst. Entering into 2020, had I said to a group of professional money managers, we're going to have a global epidemic, it's going to be a global financial crisis, where are you putting your money? I can guarantee you, and that's crystal ball with certainty, 99% of them would have said, I'm putting my money into cash, local and global. Cash local was third worst asset class out of these. Bonds global performed well, but you certainly wouldn't have said, I'm going risk on, I'm going into global equities. So, it's really interesting that we don't know everything. And even with the benefit of a crystal ball, we don't know how asset classes are going to behave. We don't know how shares are going to behave. So thank you very much for your time. I hope I didn't overstay my welcome. Big thanks from the CoreShares team to Morningstar and Gerbrandt for hosting. And we'll hand over to Q&A, and we will all be around for Q&A as long as you guys would like to stay on and ask questions.
Firstly, thanks, Chris, for that. It was very interesting. And we've seen a few questions coming in. I've also got a few questions. So I think I'm going to kick off with the first one. Is one of the panelists asked that if SA fund managers, only a select few has outperformed the global markets, should we then look at more global passive solutions instead of SA active fund managers for global space? I don't know if you've got a view on that.
Yeah, I mean, Gerbrandt, I'd also encourage you to engage, in your own capacity at Morningstar. But the challenge of being an SA active manager, stock picking in a global universe is just the opportunity set is so wide. So, there's, let me give you an example. One of the building blocks we use tracks a FTSE index that has 7,000 shares. So, sitting in South Africa, how do you have the kind of the research firepower to investigate all 7,000 shares and then still justify a cost that's higher than passive? And you're quite right. It is extremely challenging for active managers to outperform, let's say an ACWI benchmark, an all countries world index benchmark, because the costs are low. Those costs improvements come through year on year. And as I mentioned, that universe is just so large. It's not to say that there won't be active managers with their very specific niches. And so there might be a very particular reason why you select an active manager. You would struggle to justify you selecting that active manager for alpha alone, if you look at the statistics. Gerbrandt, I don't know if you want to.
Yeah, I would echo that to an extent, because we've seen the global space is very much larger than SA, and the guys need resources to be able to do research, find ideas, and a lot of the guys either piggyback off someone else's ideas or they look at other people doing, or they don't have resources. So there's only like a handful of guys who've got the experience, who've got the resources in place to actually do their research, find ideas, build portfolios, manage it over the long term. So we tend to use also on a global side, make use of passive funds where, and if we use a global solution, we tend to use people who've got big teams or that is actually sitting in the outside on the global space, but it's where that is actually their home country. The next question is from Sir. On active ETFs, do you guys have a view on it? Is there any active ETFs available in SA where the underlyings are actually actively traded?
So, I mean, we do have a view on it. If you look globally, active ETFs has been a growth area. So the idea that an ETF must be an index fund is in a way flawed, because all an ETF is an investment vehicle. And the fact that they trade on the exchange is just a means for buying and selling it, just like you're buying a fund on a list, for example. So there's no reason why active ETFs shouldn't exist. In the South African market, as per the current JSE rules, you cannot actually list an active ETF. It references, there's a lot of cross-referencing to indices and passive mandates. As I mentioned, globally, we're starting to see active ETFs come more and more in the US and Australia, the UK, and so forth. We are expecting some kind of updated JSE listing requirements open for comment to come out in the near future. So I think watch this space. I think you will see active ETFs coming to market in the relatively near future. There are a number of complications around bringing an active ETF to market. How you price it, how you make a market, how you make sure it's traded fairly, and so forth. So, once the JSE has got beyond that, I think you will see that happen.
Thanks. Another question was, have you guys considered having an equally weighted top 50 index where each company is actually same weighting?
Equally weighted property index, you said?
No, sorry, top 50 index. So for top 50, but just equally weighted.
Yeah, so I mean, if you look at our legacy as a business, CoreShares actually used to own a top 40 equally weighted indice or an index. So very similar to the top 50 equally weighted. It's extra 10 shares and equal weighted. And it was a legacy portfolio that we actually took over from Debunk. So Debunk was managing it under their Beta brand. It had been in the market for about 10 years and hadn't actually achieved any significant scale, and we remandated it. I like the concept of an equal weighted index. It's really simple and it's well diversified, but the reality is that the investors talk with their capital, and there wasn't much interest in the exposure. The one thing that is worth noting is that in a market like South Africa, where you do have a concentrated market, and we address them, some of those concentration things through caps and so forth. When you go to an equally weighted mandate, you have massive variances in the returns. So what you think you're just buying the top 50, but you actually have these very big swings in returns relative to that index, because you're coming from a concentrated starting point to what is numerically the most diversified portfolio you could construct.
Thanks. Another question is, how do we ensure having good diversification and avoid diversification using ETFs? I can maybe take that if I. So when we build our portfolios and we're selecting our fund managers, we try to use like truly active fund managers that isn't benchmark aware, but moves away. And then we use it, we combine it with like the tracker fund, the CoreShares fund. And for us, it's like when you start doing that see-through exposure, and you actually get to the end of the day where you're just getting the market, you're not actually adding anything more to the portfolio, that is when you should step away and relook your portfolio. I think there's a lot of studies been done that's saying like what is the optimal number of funds you should blend, because there is definitely a marginal like a reduction of that, of the benefit of adding more fund solution actually decreases as you build it. And I think if I remember correct, I might be 100% wrong. I think it's between 5 to 6 funds. That is, I think where people ended up is where you get that optimal blend of different views, positioning without just everybody just canceling everybody's positioning out.
Yeah, I mean, if I can touch on that, Gerbrandt, I mean, diversification, I like that, especially when you're looking at like a fund to fund level. And I completely echo Gerbrandt's kind of comments. What we as a passive house absolutely cringe is benchmark aware or benchmark cognizant active managers, because they end up charging a large fee for you actually getting 80% of your fund as benchmark. So why not rather take 80% of that exposure, buy the benchmark, and give them a 20% mandate that's high conviction, that's not benchmark cognizant, and overall you have the same outcome and you have it significantly cheaper. So when blending active and passive, you need to know on a look-through basis, what's in the portfolios, so you don't just end up having passive and then another 5 active managers that blends back to passive essentially. But that's why the emergence of businesses like Morningstar have become so popular, because they're really doing those deep dives for advisors and so forth.
Another question, you showed that SA active fund managers actually underperform the benchmark. What do you guys think the reason is that the guys struggle to actually outperform the index over the long term?
So it's obviously different in different periods. I mean, if you take the COVID crisis, for example, what we saw was, the active managers who were underperforming, say the top 50, they tended to have like a quality bias. So they're buying a lot of financial services businesses. The banks got hit hard. They were underweight resources because they had a very dim view of resources in the current environment. Resources ran extremely hard. Gold stocks in particular ran extremely hard. So these kind of bets that are binary in the outcomes that they had taken in recent history has hurt a lot of active managers. It hasn't hurt everyone, but it's hurt a lot of active managers. If you look at a value tilted portfolio, you're going to struggle to outperform beta when your value happens to be, the South African banks and insurers and so forth. So, in recent history, that if we look at stock selection and sector bets, that was a big driver. Over the long term, the big driver, and it sounds so simple, and you're probably thinking, Chris, stop going on about this, but this idea of costs, and this idea that costs erode returns so consistently over long periods of time is really what detracts from most active managers' skill. And the idea that you actually have to justify a skill level that not just exceeds your cost, but far exceeds your cost, because in order to compound those returns through time and beat the benchmark, you need to really justify that skill level, and that's the big challenge.
Thanks. So I've got a longer question. I'm going to read it, so excuse my slow reading. Quoting the relative performance in global and financial crisis versus COVID crisis, how does this factor into account the fact that arguably since the global financial crisis and up to and including COVID crisis, we've seen a record level of fiscal stimulus, i.e., that's what's been buoying the market, removes this fiscal stimulus through this period and companies falling. So then creates a fundamental opportunity for active fund managers to generate outperformance. So I think if I'm reading it correctly, the person is almost stating like this is now creating opportunity for active fund managers to outperform passives in the markets.
Yeah, so the concept of like cheap money, right? A lot of cheap money sloshing around the capital markets, and that money finding a home, and that home happens to be equities, is something that's kind of been discussed in the past. I mean, it's quite interesting because let's look at the US market. Now, the US market, active management tended to underperform because they were underweight the big tech stocks, which ran extremely hard. Tech just happened. And again, this is where the kind of crystal ball story comes, to be perfectly positioned for a COVID crisis. Everyone go home, work from home, more and more engaged digitally, more and more use our services and platforms. We're on Zoom now. I mean, that's an interesting case study. So in the US, it was, yeah, there was cheap money lying around, but also the reality was that active managers weren't positioned for the crash that happened. So, you know, this idea that active managers can anticipate, and not only anticipate, but then position their portfolio correctly, is one that we believe is flawed. And I think under the underlying or the overarching premise of that question is that, yeah, it's been tough because money's been cheap, but guys are going to know when money doesn't get cheap exactly where they have their money, or active managers are. I think that concept to me is flawed because we don't. If money gets more expensive, if we return to a normal fiscal environment where interest rates normalize, you know, where this global hunt, insatiable hunt for yield exists, where that falls away, you know, where do you position your portfolio? You know, that's the interesting question, because that's the tough question to answer. And when does it happen? I mean, 2013, we were talking about, you know, we're bottoming out now. Rates can't remain this low for this long. And here we are like 7 to 8 years down the track, and we're seeing negative interest rates. We're seeing all sorts of strange things. So the idea of being able to crystal ball, to be able to predict future capital market environments and so forth, is very challenging, if not impossible. And then how you position your portfolio, even if you do have the crystal ball. I mean, I touched on, let's say, the COVID crisis, and you know, where do you put your money if you know you're going into a crisis? Well, typically you go into cash, you go into stable assets, and global equities being the best performing asset class last year. I mean, that's counterintuitive for most professional money managers. So yeah, that's the US market, and look, there is a lot of money sloshing around the system that is looking for a home, and equities have been the beneficiary. So this hard bull run that we're seeing in like global equities has certainly been a factor of you know, this cheap money. In the South African market, I would say less so. I mean, we've seen a bit of an emerging markets risk on appetite in the last 6 months or so, and that definitely is cheap money looking for a home, looking for yield. But through the COVID crisis, there certainly wasn't global capital flows as a function of this low interest rate environment, this strange fiscal and monetary environment that flooded into SA equities, and the active managers couldn't anticipate that, and that's why they underperformed. I think typically they underperformed because they were poorly positioned from an outcomes perspective. So they didn't consider the binary impacts of some of their investment decisions that they had made. Gerbrandt, you've probably got a better view on it.
Yeah, so this money sloshing around has created opportunities, and I think it's also due to the fact that we've got this inherent biases, where I think example was people just, Tesla, maybe it's a great example, where people just like, it's going to be amazing, it's going to be the next best thing, and everybody just buys into that dream and idea. It's a great company, but at the current valuations, maybe it's not best. So that's why we prefer to blend, because if you have great active fund managers that can actually find those opportunities and not just following the herd or just trying to do momentum, that's where you can add the benefit to it. But if you're just following the herd, which is momentum, we are happy just to have a core allocation to a passive. And I think the last question is going to be, someone says, thank you very much for a great presentation, but what is the optimal mix for active and passive funds from an SA perspective and a global perspective? And I almost want to say, dial into the next week's session when the answer will be revealed. But I don't know if, like Chris, maybe has got like a quick answer, quick view.
I agree with you. Dial into next week's session. Vicky from Morningstar is going to be looking at exactly that, blending active and passive and how they think about the world. We did some research a number of years ago for your interest. We basically copied research that Vanguard did. They looked at manager skill and the ability for fund pickers to select, the outperformers and on a consistency basis. And they called it like partial skill and full skill and so forth. And in the offshore market, it was very difficult to justify an active inclusion. So it became very difficult, actually. This optimal blend was like 97% passive and 3% active when they looked at like the numbers and the probabilities of doing so. In our market, it was slightly more skewed actually to active. And one of the reasons was because the benchmark tends to have a bit more volatility than a lot of the active managers. So when we look at like a risk-adjusted return environment, there actually is a benefit to blending an active beyond just the return seeking. So what Gerbrandt's talking about is blending and different skill sets and different styles. That talks to the experience that the investor has in low levels of risk and smoother outcomes and so forth. So that was like more like 70-30, but still 70% in passive and 30. I'm sure it's kind of a rule of thumb. You really need to understand your clients, and as I say, Vicky's going to be unpacking that in detail next week. So I won't spoil her thunder.
Great, thanks. So I just want to thank everybody again for joining us today this morning. Thank you for the great questions, and reach out to us on email if you've got additional questions or we feel we didn't answer your questions. And again, I'm going to encourage you to assign for the next session. Victoria is going to chat about portfolio construction and passive solutions. And then the last housekeeping I just want to remind you all about is when closing this, make sure you fill in the survey and remember to fill in your ID number if you want that CPD points. And just thank you. And hopefully we'll chat to you all soon face to face.
100%. Thank you, everyone. And thanks, Gerbrandt, for hosting.
Pleasure. Have a great day, everyone. Cheers.
Nice.